You're not the only one that closed their underweight on small caps last week, quite clearly.
We're not in the business of standing in front of moving trains.
Why can this continue?
Well, we're not sure it is going to continue for very long. We see this as sort of a multi-month position change. We could see ourselves easily moving back to underweight if we either see growth weaken or if it seems like we're not going to get the rate cuts that the market is priced in. The market is well ahead of the Fed. This is clearly what's propelled a lot of the small cap optimism. We need to see some of the earnings fill in behind this optimism, behind the re-rating in small caps. We need to see home builders turn around. We need to see more construction, more hiring generally in the economy, so we see the cyclical upturn in the second half of the year, which is the only way we're going to hit small cap earnings targets for 2025.
When you start to think about earnings, are you more convinced by the earnings that may come from big cap tech? And would you be unwilling to sell some of those major players to fund this long that we're seeing develop in small caps?
So effectively, we have done that because we had this overweight to large cap. So we have been selling some of those very high earning, high growth companies. But again, we're not buying into sort of a junky rally here for small cap. We're still emphasizing quality across the portfolio, which means that even being neutral, we could see ourselves underperforming the small cap index in this kind of environment where things are sort of indiscriminately moving upward. What we're really concerned about, though, is the fundamental story in 2025 and the very, very ambitious earnings targets that, if they're not met, it's not really going to matter how many times the Fed's cutting rates.